Welcome to the Ides of Macro, where we discuss investing and trading through the lens of global macroeconomics. Julian Brigden, welcome to the Ides of Macro. Just as you're drinking it there, the second episode that we've done, and where we talk about everything macro. So welcome on board.
Thank you, Roger. Thanks for having me, mate. Sorry about that. You were much quicker than I thought you'd be.
There's a 5 countdown. It's not a hard one. So I just want to get straight into this because it's been a fascinating market over the last really 18 months where it feels like we're kind of being dragged towards this sort of recessionary type concept, but yet there are still certain elements which are stubbornly holding on to not being recessionary. What are your thoughts here? Do you think we will naturally go into a recession, or do you think that the Fed has to still manufacture and still has to do a little bit more work? Because it feels like the Fed considers a recession versus inflation. It considers recession the lesser of those two evils, and therefore it will make sure that it's done its job on inflation before it worries about growth and recession. What's your feeling? Where do you think we are?
So I think you're right in terms of weighting where the Fed's thought process is and their head is. I think in many respects the soft landing spin was simply kabuki theatre, right? It was expedient, politically orientated kabuki theatre aimed at obfuscating the reality is that the way that you break the back of inflation is you drive the economy into recession. So I think that was always the plan. I think one of the things that we've been thinking about is that this sort of concept of soft landing, no landing thing, Roger, was purely and utterly a reflection that people forgot that, monetary policy works with a lag. And the reality of the situation is we're only just feeling the impacts of the first few rate hikes, and this thing is going to come and hit people with a pretty big whack, I think, as we move through the year. We've just done a series for the MI2 client base where we've looked at sort of 3 areas of the economy. The first one was credit, and that was even before SVB. And all the events and the sort of fallout in the regional bank crisis. And even then, and it's an incredibly good sort of leading indicator, when you looked at the credit cycle, you were starting to see, really starting in 2021, but it just works with such a long lead. As soon as the Fed started to tighten rates, banks started to tighten lending standards. That's been met with, interestingly, falling credit demand, particularly from the corporate sector. That's going to manifest itself in things like CapEx, C&I lending, so commercial and industrial lending. It's going to manifest itself in consumer spending. You could already see the consumer credit numbers, which are running around 40 billion a month, have dropped materially, and I think are going to go negative. That's going to come through and hit retail sales and ultimately employment. And employment's kind of the last lagging kind of indicator. But I think there the dynamics are starting to move. So there's credit. Now SVB and events there seems to have materially accelerated that, Roger. And while there isn't that much up-to-date data which kind of encapsulates that, there's a couple of series that we've been looking at, which if they're right, and I'm cautious in inverted commas, suggest potentially a credit tightening which is not that far off the worst in 30 years outside the GFC. So that's very bad. Second issue is one around the housing market and the construction story. Now, don't get me wrong, I'm not saying this is 08, 09 once again, but we've got an extraordinary unattractive housing market at the moment, in the sense that houses are very expensive. We're just about to get higher unemployment, and hitting that is an almost unprecedented number of new houses that are under construction. And if you look at the multifamily space, a very large, very unattractive from a funding perspective, cap rates, et cetera, backdrop. So I think we're looking at a big slowdown in construction activity, right? And then the third one is the inventory cycle. Now, we sort of thought we'd banished the inventory cycle, right? That was a thing of, pre what we refer to in economic terms as the Great Moderation. So this sort of pre the globalization, which started in the mid-'80s, which enabled you to move to just-in-time inventory management. So you didn't have to have these big levels of inventories. And I think we've gone back to a pre-1985 way where we moved, during COVID, we over-ordered. That moves us to just in case. And that's fine, but it comes with a cost. It comes with the volatility of, oh shit, I've got way too many inventories. Let me cut my production as the sales starts to go. And I think we could end up with a very vicious inventory cycle. So I think we've got a bit of a trifecta here, Roger. And I think the odds are growing that we're looking at, I'll caveat it again, a good old-fashioned hard landing. And by that I mean not a 2008, 2009 type credit crisis, but just a good, nasty, ugly recession.
And I think, it's what you're saying there is interesting, because the way I looked at this as always being, last year was a price shock. And we were waiting for the growth shock to come through. And there's this transition window,
right,
where everything would look okay, which is what we've had. And then that slap across the face was what we saw with the banks. So I think we now had the slap, and we're sort of now going into, we can now have a growth shock, because for a few months we all thought everything was going to be tickety-boo. But on that recession front...
And I think as well, we've got to, just if I may, just one observation. Yeah. I mean, I think, because you raise an interesting point. Inflation, and let's call it nominal GDP, tends to obfuscate what's going on, because it just that cash just sort of in nominal terms fills the gap. So I think, if you looked at the classic one I like to quote is Procter & Gamble just came out and announced, I think it was like a 6 or 7% increase in profits. Now that was on the back of a 10% increase in pricing, which means that their volumes fell 3 to 4%. Now, that's fine, because that's, corporate profits are calculated on a nominal basis. But the problem is the economy works on a real or unit basis. So it's fine that Procter & Gamble said, well, our numbers are up 6 or 7%. The equity market goes, woohoo, great. But it isn't sustainable if that's pushed across the whole economy, because Procter & Gamble are cutting production. They're not selling as many units by 3 to 4%. So you push that across the economy, and all of a sudden you've got 3 to 4% less industrial production, 3 to 4% less transport, 3 to 4% less employment. And we know that we hit this tipping point. So I'm exactly in your camp that we're in this kind of foggy land where it all kind of looks okay, but if you actually lift the lid, it bloody is beginning to stink.
And what actually, just touching on that point there, because one thing, I think you've been one of the advocates for this as well, which is, and you were just mentioning there, which is that one of the big problems we've had is that the pricing power of corporates has created this sticky inflation, and this is why the Fed might need to go harder, because the Fed needs to basically go, come on lads, come on girls, you can't keep putting up these prices when your volumes are falling just to keep your margins where they are. If you keep doing that, we're going to get sticky inflation, so we're going to have to hit you. It feels like that kind of corporate-led inflation is the reason why the Fed might still have to surprise with more tightening.
Yeah, there was a brilliant chart which John Author did on Bloomberg today, where he showed the share of corporate share of GDP is now as high as 1929. I mean, this is something that I've maintained, right? If you in what is actually a pretty uncompetitive economy in many respects in the United States, right? Oligopolistic from everything from, as we found out, slaughterhouses through internet providers, through purchasing of white goods, right, where you have to stick to the MSRP. This is actually a bloody uncompetitive economy. And when you give that degree of pricing power and oligopolistic power to the corporate sector, and you push up their costs, but at the same time you give consumers a big check to enable them to pay that cost. Guess what's going to happen, Roger? The US corporate sector is going to stick its hand in your pocket to the point that it extracts every single last red cent and more. Yeah. So if you're the Fed, the only solution basically, and this is why we've maintained this, is you have to crush demand, Because moral suasion's never going to work on the corporate sector, right? You're going to have to crush demand to the point that the US corporate sector cannot pass those price increases through. And I think, look, I think was always the intention. What I think is different now, Roger, is the intention, as I said, was never a no landing, right? That sort of soft landing scenario just never made sense to me. The intention always was a recession. In fact, if you look at the Fed's forecast, there was a glaring inconsistency in that. They had this sort of, their SEPs, the published forecast that they put out for the economy, they had this sort of bizarre 1% rise in unemployment, which would then track sideways for 3 years, and yet no recession. I mean, decidedly Goldilocks, right? And inflation would fall the whole time. The trouble is, it's never occurred in the post-war period. You've never had a 1% increase in unemployment without a recession, and inflation and unemployment never really tracks sideways. Once it starts to rise, it goes up. So I've always, to be honest, thought that was a bit of BS on their behalf, and as I said, a bit of political expediency to cover their asses so they don't want to get the blame, because they don't want to get too many of those sessions like they had with Elizabeth Warren, where she correctly nailed them. So I think the intention was always a recession, but I think now, given what we're starting to see, I think actually the odds are it's an uglier recession than they intended.
And do you think that they still need to tighten a bit more, or do you think now they can go, okay, we can reset it a little bit, or at least pause? Because, you know, one thing you've talked about in terms of yield curves, etc., which is this whole, you know, yield curve inverts, goes negative, then it starts to re-steep, and then you get a recession, which is always true in the moderation period of 1990. But if you go into the 70s, they keep tightening, so that actually the inversion keeps on going until the steepest point is at the recession, which makes sense because they have to go, we've got to tighten until we kill something. The back end eventually works out, you know, and those yields fall relative to that front end. So it does that, and then yes, it re-steepens through the recession, but it had these very, very volatile yield curves. And even now, I think, was it 3-month, 10-year, because obviously 3 month is locked to the Fed funds.
Yep.
That's actually now at a not record low, but it's still moving to new lows relative to the cycle, which makes sense if they still have to keep tightening. So,
look, do they manage to eke another 25 out in May? Maybe. I think a lot will depend, you know, on the timing of the data. I mean, it's quite unusual, Roger. I mean, you know, to get typically when ISM manufacturing, which is what the kind of leading indicators, you know, you know this, you know, as a macro specialist. I mean, manufacturing is a tiny proportion of the economy, but it tends to be the leading indicator. And it's very unusual for the Fed to be hiking once you start to cross sort of 49.5 on ISM manufacturing, and we're well below that, right? I love listening to the conference call of that they do after this, and Tim Fiore, who's the current chairman of the ISM manufacturing survey, the change in tone this month was really, really noticeable, really, really noticeable. So it's quite unusual for the Fed to do that. So I think they're kind of pile driving us into recession, and I think, as I said, that was kind of the intention. So when it comes to the curve, the problem, you know, we've moved into the sort of steepening camp. Now the question is where, right? 3s, 10s, you know, 3-month, 10-year, 2-year, 10-year, 2-year, 30-year, 5-year, 30-year. And I think one of the things that I've been fortunate enough to pick up, because some of my sort of connections with my old policy side, is exactly where the Fed's head was in terms of this policy tightening. So when you get inflation of this sort of magnitude, there's really only sort of two policy options. You can pursue what's referred to as deliberate disinflation. So this is sort of Volcker-esque. You literally drive the economy into recession. You deliberately kill the patient. Or you can pursue what is referred to as opportunistic disinflation. Now, opportunistic disinflation doesn't necessarily mean you remove the risk of the client's debt. It doesn't mean you remove the risk of recession. But you don't really drive your knife into the patient's heart, right? What you do is you sort of suppress the patient to the point that you can take advantage opportunistically of other events that may occur. You would like a nice event to occur. You would like, some sort of exogenous event to come along and either drive productivity up materially, which would you remove some of that inflationary pressure, or you'd like, some new invention to come along, whatever it is to kind of, that doesn't require the pain, but it doesn't preclude the pain. But the problem is when you pursue a opportunistically disinflationary policy frame, which the last time we tried it was in the mid-90s under Greenspan, it takes a bloody long time, Roger, to potentially play out, because you're waiting for the events. And, it's like waiting for a bloody bus in London, right? You might wait for an hour, and then all three come along at once, right? So when you look at that situation, what does that mean? Basically what it means is that policy essentially becomes asymmetric. So you wait and embrace the weakness, and policy doesn't get eased, which I think could become a problem for the market in terms of what it's been pricing in at the very, very front end. So let's say for this year, you kind of wait, you go, okay, it's weak, that's what I wanted, no, right? But what you do is you raise rates again if the data is strong. And that's what we've seen over the last, since the start of this year, right? The data's come in much stronger, they've kept going, okay? Now, because they are going to potentially sit on the sidelines and embrace that weakness for longer than expected, I'm a little bit hesitant when it comes to the curve to place my bets too close to the front end, right? I'm not playing in 3 months. I'm not playing in 1 year. I'm not even playing in 2 years, although I suspect by 2 years things will have really materially deteriorated. My bets right here, right now, are I'm doing the 5s, 30s curve. So I'm betting that 5-year yields are going to fall, because if 2 years are kind of fixed, you'll get all the flex kind of here, and that 5-year yields will start to fall materially, and that you'll get a bull steepener as that pivots like that. 5-year yields drop and 30 years kind of stay where they are.
And that's because for people watching it, sort of 2 year is really a sort of a sense of where the Fed should be. It's kind of an emotional kind of view on the Fed. 30 years is a little bit more inflation sensitivity, and that sort of 5 and 10 year space is a little bit optimism, pessimism. So if you're going into the pessimism recession, 5 and 7 year yields should fall. 30 year, but if they cut too quickly, or everyone thinks they cut too quickly, then 30 year might be sticky and go up, because people go, ooh, inflation could come back down the road.
And that's this you raise an important point, Roger, right? Because a lot of people have said to me, why don't you just go and buy 5-year bonds, right? And don't get me wrong, most of the listeners to this, it's very bloody hard to go and do some sort of steepen a trade, and balance it all out. Like, what you really just want to go is go and buy bonds, right? And Raoul's talked about this quite a lot on Macro Insiders. So I flagged that I was looking at levels on the IEF technical levels on the bond market, and I'm long that sector myself. So, but the problem becomes that longer dated area. And why do I prefer a steepen as opposed to an outright long? Or why do I prefer an outright long in shorter, when I should really, if I want most bang for my buck, going really, really long to get that duration kicker? And the reason is I'm a little concerned about the long end, Roger. I'm actually worried that what the regional banking crisis has illustrated to us is the inability, potentially, for the Fed to raise rates sufficiently to choke inflation out of the system. So if you want to get all kind of technical and a bit sort of economistic wonky, we have just discovered that R double star is below R star. So the level of rates that's commensurate with a stable financial system is below the level of rates that's commensurate with a stable economy. And if that is the case, Roger, and this is ultimately where Raoul and I disagree, I am very concerned about the ability of the Fed to truly wring inflation out of the system. Don't get me wrong, it will fall in a recession, but to what level, right? Will it go back to the prior lows, or are we looking at a situation like the 60s and 70s where it rolls, but every time you get a higher low, and then you kick off again? I'm also quite concerned that if we go into 2024 at the end of this year and we're in a pretty ugly recession, I really wouldn't put it, in fact, it'd be my base case, that Congress will be looking to spend even more money. And that's kind of what happened in the 60s and 70s and kept the inflation cycle going, and that's what worries me. So I like the idea of a steepener because I get that bull steepener, that recessionary kind of move. But I also cover my arse just in case things go very wrong fiscally and monetarily, and the long end of the bond market goes, I don't like this. Right? I don't trust the Fed's ability to wring inflation out of the system.
And so it sounds like what you're thinking the Fed is probably going to do is, and I think you alluded to the market getting a little bit overexcited because the market keeps going for this pivot. It goes up, straight back down again.
Yeah.
But and actually what's happened is that if that's that pivot has just moved from February through the middle of the year towards the end of the year. So actually it's been a plateau. And I think it sounds like the Fed may well plateau, which is what you talked about in the 1990s, where they get up to 5% and then they sort of hold it there or thereabouts. And at the same time, I guess the other thing is you mentioned, which is, and they will be a little bit more reactive because we've been so used to the last 30 years of rates go up, rates go down,
yep.
Rates go up at the same amount every time. But prior to 1990, they go up, they go down, they go up a lot more, they go down. So it sounds like they might go plateau and then see which way as and when the data comes out.
Yeah, and I think this is, we got so used to this, as you said, this sort of post-08, 09 world where, the Fed is your friend, right? They always come to your rescue. Weakness is a source of joy, right? Because you go and buy stocks because they're going to print more money or ease rates or whatever. And I think there's a possibility that we're just not in that world anymore. And in fact, I distinctly believe we're not in that world anymore. So I'm a little reticent about, buying stocks. Don't get me wrong. I mean, I think, this recent bounce we've had in the equity market is a function of the fact that the Fed's been realistically compromised on their objectives, right? They're trying to do QT, and yet they've had to re-expand the balance sheet to help the banks out. And I think that's fine. But and I do believe that asset prices are set by liquidity as opposed to fundamentals, right? I mean, I hate to say it, it served me well. I don't think we're in a real world anymore. We just print shitloads of money and assets go up and you go, oh, look, great, it's a bull market. And then, a whole bunch of analysts and journalists write a narrative that fits the price action as opposed to actually do any of the work. But I think the risks are growing. I think the risks are growing in particular to the US equity market on a relative basis. And I just don't think people appreciate how tied this whole game is, right? We look at this and we go, oh, the Nasdaq's up, right? Well, I mean, at the start of this year, we wrote, sent a bunch of charts to our clients saying, you noticing we're breaking decade-long relative performance charts of the US equity market against pretty much everything? And I think, to me, that's the most exciting thing, Roger. If I look at the macro space, this kind of dominance of the US that's occurred really since 09, but accelerating as the dollar moved up in 2011 and then again in 2014, I think could be coming to an end. If that's the case, then you and I know that once you change the direction of the dollar, the whole macro world changes and the opportunities are enormous. Are we there yet? But, kind of looking good.
And with that, because you talked about the types of ways you can have a recession, there's the good or the asset reaction, the good and the bad. I've always felt that when you get the change in leadership, you really get the proper change in leadership as the phoenix rising from the ashes. It's the change of direction after the event. Do you think that this is an event where it's going to be so concentrated in the US that with a global recessionary type environment, the US will underperform on the way down? Or do you think there will be some flight to safety? But then when we eventually get through the recession, it's okay, now we reset and we go Europe or we go emerging markets. Or do you just think the US loses out in both the down and the up?
So typically when you've gone into sort of prior recession, so you go into, say, 2000 or even sort of 2007. 2007 is a little late was a little unique because you had that collapse in the US banking sector, which sort of sucked dollars back into the system from the rest of the world. But if you go back into sort of 2000, the first thing that is the reason I think the dollar rose into the recession was that, there was a lot of money that overseas still, right? We'd been pushing money into emerging markets, into the emerging market bubble in 97, 98. And that money was still sort of coming back even as we were talking in 2000. And then the dollar, you did get a little bit of that risk-off dollar up move, kind of the napalm run. But I think, and then eventually as the Fed started to cut, then the dollar turned around, and you got that kind of nice, what you're talking about, Roger, that sort of reflationary dollar move. And that's why from 2002 to 2008, pretty much everything else that wasn't in the US outperformed, right, in dollar terms. This time, I think it's a little different. Now, I thought the dollar, I'll be honest with you, I thought the dollar was going to turn at the end of last year. No, sorry, at the end of 2021. And then we got Ukraine. And Ukraine kind of sucked that final ounce of money that into the US. But I think the point is right here, right now, all the world's money is in the US, Roger. I really think it's in the US. I think we have had this self-reinforcing, virtuous market and economic cycle, which you and I have seen on numerous occasions in our career. For example, we saw in Australia from 2009 to sort of 2011, where it truly is, in the sorest sense of the word, becomes reflexive. So it becomes self-generating, self-reinforcing. So, the dollar starts to go up in 2011. Foreigners want to own dollars because the dollar's going up. They buy dollars. They then look for something to invest them in. So they buy US stocks, which outperform, or they buy US corporate debt, which the corporates then take the money and buy US stocks. So those outperform. So the circle goes up. As the US stock market's going up, the wealth effect kicks off here in the US. The consumer booms. The Fed raises rates. The dollar goes up even more. The booming economy sucks in lots of imports. We run a big current account deficit, and Johnny Foreigner is more than happy to fund it for us via buying more US assets. Well, we've been doing that now for the best part of 12 years, and all the bloody money is here. And it looks like an impenetrable edifice, right? It looks bulletproof, Roger, right? It's always self-reinforcing. But it is at its core the very definition of an unstable, stable equilibrium, right? With three codependent legs. The first one being, well, the dollar has to remain strong, okay, because all that money that's sitting in the US has to be unhedged from foreigners. That's how we fund the current account deficit. So the dollar has to remain strong. US assets have to continue to relatively outperform. Otherwise, at some point, Mrs. Watanabe or Mrs. Schmidt in Germany are going to look at their statement and go, oh, in yen or euro terms, I haven't done very well on my NASDAQ this year. Let me go and sell it and go and buy something back home. And thirdly, the US has got to continue to need that money to fund that current account deficit, which means that the economy has got to remain strong. Because if we go into recession, that current account deficit will shrink. And with that, our need for foreign money will dissipate, and that money will go home. So I kind of look at the dynamics, and if we go in sort of reverse order, we're definitely going into recession. The current account deficit is definitely shrinking. If you look at the relative performance of US equities, they're starting to underperform in foreign currency terms quite materially since the start of the year. Not everywhere, but certainly against Europe, which is, a big part of the funder of this. And that really only leaves the dollar. And I think we're at an interesting point where either the Fed is potentially compromised on their ability to fight inflation, which is dollar negative, or secondly, they may just have misunderstood how bad the recession is going to be, and they're going to have to cut rates a lot more than they think, in which case the dollar is potentially compromised. So I think it's a really, really interesting point right here, right now.
And do you think that, there's a lot of people who will look at this and go, yes, I agree on the NASDAQ, because I think the breadth of the NASDAQ is the worst it's ever been in terms of the overall performance coming from 7 stocks. But would people, maybe people go, well, actually, what I really want to do here is switch out to the NASDAQ, those 7 stocks, and into those big international US stocks that are kind of, more value plays, more commodity plays, more kind of real world plays, of which there's still quite a lot in the US, because they've been lagging the tech stocks as in the same way that everyone's been lagging the US.
God.
So it's the first move out of tech, out of NASDAQ into effectively the rest of the S&P, maybe for the next year. And then in a year's time, it's like, now Europe, because I think of Europe and I'm amazed where the DAX is. It's near its all-time highs. I'm going, it's major.
Exactly.
I mean, that shouldn't be there either. Europe, I get why some of the dregs of Europe of old might start to outperform. But when I look at the DAX, I go, oh my God, its major export partner is China and everything leading into China. And China's not doing anything at the moment and is changing the way it does things. So actually, I might go, I'll do S&P global stocks first out of tech rather than Europe. I mean, maybe that takes a while to play out.
Here's the problem, Roger. You illustrate a really big conundrum. It's like that curve steepener thing, right? For non-pros, this is actually a very, very difficult time, because what you're essentially playing is you're talking about a relative trade. You're talking about the US underperforming, and on a relative basis, Europe outperforming, or you're talking about US tech underperforming and US growth outperforming. And they're really kind of manifestations of the same thing. The problem is that relative trade can happen what we would refer to as the nice way or the nasty way, right? And the nice way is, sure, you go and buy a bunch of European stocks, or you go buy a bunch of growth and it goes up, and the US goes flat and US tech goes flat. However, there is the nasty way, Roger. And certainly is when you go into a recession, the odds are that it's the nasty way that kind of prevails, at least initially. And that means that, yeah, sure, you go and buy a bunch of growth, or you go and buy a bunch of European stocks, but they go down. It's just that they go down less than US value. They go just down less than US growth, US tech, and the US market in general. And that means it's actually quite a bit of a difficult trade to run. And so when I look at our approach with Macro Insiders, one of the things that we've really endeavored to do is try to explain to people, look, I like owning gold, right? I like owning silver. I like owning XME, the minings and metals stocks. There's some other stuff that I kind of like, right? But there are going to come points where I become nervous, and in that situation, what do I want to do? I kind of want to sell some S&P against it, or something in the US, because I want to have that buffer of that relative trade. I mean, it's just hard to do when you're trying to invest in your 401k with Vanguard, because they won't let you go short anything. Right?
I mean, I was about to say, because it sounds like the equity market is a bleeding minefield, because you've got to get the relative trade on. You might get the right relative place, but you might still be down 20%. So you mentioned there that, there's the other things you can look at. So you can look at the metals. I mean, gold, everyone's been focused on. It's probably got a little bit beyond itself over the last week or so. But it looks great. I mean, God, if it can break 2050 properly, fantastic.
I really like at this point, you look at some of the miners, right? Some of the if you look at where gold and silver have moved, the underlying metals, the miners are beginning to look a little stretched. So yes, I concur that short term, both the metals look a little toppy. But if we can make that break, or on weakness, I'd be tempted to buy more of the miners myself. But maybe that's just because I'm just a bit of a spiv. Yeah,
I think you are actually, because I'm just wondering here, if we're going into recession, if we're going into recession, it's one of these things where timing, as always, but it feels like we're having commodity prices going up because of liquidity stories and structural supply, lack of investment issues. So this is not the 2000s where prices went up because of demand and volume was huge, volume growth was huge. So commodities went up, but commodity miners and producers went up even more because it was a volume and price story. Today it's a little bit, seems to be a bit more of a price story and less of a volume. And if we go into recession, I wouldn't want to be long miners in a recession because they have such a high beta. Maybe just about some of the energy stocks. But isn't this a case of we should be long the metals first? So your gold and silver.
I was talking very specific. Yeah, sorry. I was talking very specifically the sort of precious metal miners. I think it's the wrong time probably to be in. One of our long-term trades is long XME, short S&P, right? And that's one of our sort of favorite trades. But we took it off and we're waiting to get back into the trade, having had a nice little run on that. And to exactly that point, if you're going into recession, the industrial stuff is not the stuff that you're wanting to play. Essentially what you are really playing, Roger, is you're playing a negative dollar trade, right? And if you want a high beta trade to that, a very sensitive trade to that, what you're looking at is precious metals, gold obviously first, then silver, and then if you want a really leveraged balls to the wall trade, then you're doing silver miners, right? So that's kind of what, and I agree, the timing is absolutely key. It's all critical. And you don't put your life savings in this, please, ladies and gentlemen, right? This is a big aggressive part. But it's like, essentially being long Bitcoin, I guess. It's the same sort of thing. It's a high beta trade that should respond well to a negative dollar. But actually, I was funny, as we're chatting, I'm looking at the Invesco agricultural index, DBA. As I look at that now, actually, it looks quite bloody good, actually. I mean, it's been stuck in a range, and that's also quite a big anti-dollar trade. So I think, to me, right here, right now, I have some long precious metals on. We have some long precious metals on. We're short dollar yen, but I haven't yet pushed hard into this is the top on the dollar. This thing is going. Because if we I'm playing with that thesis, Roger, but if it happens, you and I know, Matt. I mean, Raoul has always, his favorite expression is you go and buy emerging markets, you go and buy precious metals, and you go and lie on the beach for the next 5 years, right?
Yeah. And with those, I mean, what I think is really interesting at this time is that, again, not like the 2000s, it's not a case of buy all emerging markets, even though, the dollar trade obviously has always worked. It feels like this is a world, because of issues with energy, etc., more differentiated. There will be clear winners and losers within the emerging market space, whereas 2000s was, just close your eyes and fingers in the air and buy all emerging markets, and they all went up. But this feels slightly different today.
I would concur, and I'd also add that I think the geopolitics has shifted, right? I mean, I think part of the problems with the EEM as an index is it's got such a high weighting of China, and I've always been in the camp that not always, but over the last few years we've come increasingly to say to clients, you're going to need to buy what you're allowed to buy, not what you want to buy. I'm firmly in the camp, and I've said this to the crypto community. It's not that I don't think it's a decent trade. I think Raoul's purchase of Bitcoin off the lows of 12,000 was masterfully timed. I get concerned that if we're moving into the geopolitical world, which I think we are, US investors or European investors are going to increasingly have to focus on what they're able to buy. And I'm not sure, you can see it's pretty hard already to get your money into the crypto space, right? And certainly to get it out, right? It's increasingly an isolated vacuum kind of community. But I think when it comes to EM, you've got to be cognizant that you may not be allowed to hold Chinese equities in 3 or 4 years' time. So, if you're looking at long-term capital gains, I think you really got to be cognizant about what you do buy, Roger.
I suppose there's a little danger there.
But it should be good.
I mean, one of the dangers with that, though, is that it could be that all the American investors go, oh, you know what, I'll just bring my money back to the US. And up goes the NASDAQ again. Because but
the trouble is, they haven't got them. Yeah, it's true, but their money's not here. It's not overseas. I mean, this is one of my, if you go and ask the average registered investor advisor, right, what the portfolio is of his client base, then on paper it should be, in the equity pool, it should be 65-35, 65 domestic, 35 overseas. It's not even close, mate. It's not even close. My guess is it's probably, and this is based on conversations that I've had with registered investment advisors, is probably 90-10, 95-5 domestic. Americans have no money. I mean, you'd have been a bloody muppet to have money overseas, right? This is the point. You've made the last decade, I mean, I was looking at this, if you'd have been an American investor and you'd have put money into the IBEX, so the Spanish equity market, in 2011, so at the dollar lows, how much would you be up? Oh, no, in 2009, how much would you be up, Roger? Take a guess.
I don't know, but I've got no idea. I forgot the IBEX even existed.
20%, mate.
Oh,
20%.
Right.
20%. If you'd have been in the NASDAQ, you'd have been up thousands of percent, right? So the point is that's my point. We are at this point where all the money is here. And to me, going forward, it's that flow of funds driven by the fundamentals, right? It's that flow of funds that is going to be the most important dynamic to get right for 2023, right? And, maybe that was the same case for 2022. It's just that, and it looked pretty dodgy in 2022. It's just Ukraine came along, and that last ounce of money that was sitting anywhere else in the rest of the world went, shit, I'm going to the US, it's safe there, right?
And then in terms of this time, it's sort of just kind of coming back to it because, obviously timing a recession, or not timing a recession, we all get overly excited about recessions, I always think. I think there's some great opportunities to go and be long and short. Never, but at the end of the day, we all get our stars and stripes, all the rest of it from going, oh, I nailed the recession. But with recessions, you mentioned it earlier, when you get a recession, you always have rising unemployment. Sometimes rising unemployment leads to the recession, or recessions lead to rising unemployment. They're coincident, but that's what matters. And yet here we are with, we've got this bizarre sort of conundrum because of COVID, we've got so many distortions to the data anyway. We don't know whether the data's right, wrong, whether it's all changed. But the unemployment is, and I say that unemployment is tight, but the employment situation is not strong, even though at 3.5%. It's because, I don't think Labour has much power at the moment, but there is a low unemployment. How can people what should people be looking at? Because if it's the unemployment picking up that tells us we're in a recession, and we always get lows in the equity market in recession every single time since the war, because as unemployment goes up, people panic and they start liquidating assets because they have to, because they've lost their jobs. How can we monitor that? What can we look at to go, oh, I can see unemployment is properly picking up?
So I think you're basically asking what are the signs of a recession. I mean, there's a couple of things that I watch. One of the ones that I push to people is historically, once ISM manufacturing new orders drop below 47.2, unless the Fed punts the cycle, so re-eases, that's a recessionary sign. Well, we've been there since November. It's not an immediate recessionary sign, but it's pretty much guarantees it delivers you a recession. Another one you can watch is you can look at the rate of change of continued claims. Once that starts to clip about 10% year over year, you're either in the recession or you're a quarter away from the recession. There's one exception, but the Fed, once again, was already easing into that. And so when I look at things, and that's the interesting thing, Roger, is recessions or employment is kind of a momentum game, right? If you look at a chart, if you go back and you look at a long-term chart of unemployment, it kind of looks like, a Swiss mountain range, a piece of Toblerone, right? Very, very sharp tops, and then kind of these extended valleys that sort of base out and then slowly start to rise. Now, once you start to rise and you lose that momentum, they don't go sideways per the Fed's fictitious economic forecasts of 4.5, 4.6% for the next three years. They rise again. And it really is a momentum game. So I like looking at the momentum in employment, and the momentum in employment is starting to wane. I mean, whether it's now that we have the recession or not, is kind of fictitious, immaterial, because it's when, then we get told in hindsight, right, where the economic forecasters come back and say, oh, you started a recession in January, and you're like, oh, cheers, thanks. I thought that was the case, right? And it doesn't really matter. So, yeah.
But you can see with both initial jobless claims and the unemployment absolute numbers, you're right, they need to start turning up, and they're not even starting turning up yet. Now, again, is this because we're going to suddenly find they're all revised to buggery in the next few months, so we look back and yes, shit, we're already in a recession? But they haven't really started turning yet. I mean, where's this unemployment going to pick up from?
I think they have. But I will concur with you. We are not yet in the particularly aggressive layoff phase. I think what we're doing is the number of jobs that's being created is starting to drop materially. And when I'll be bold and say, in Q2, so that gives me to July, right? Because then I get the June print in July. I think non-farm payroll will probably go negative.
Okay, so that's a market.
But it doesn't mean from there, it goes. It could. I think it could go minus, 100,000, minus 200,000, that sort of thing. I think we're getting there, but I think there's definitely the level of job creation is beginning to materially slow. I think what job creation we are seeing is kind of a holdover from people who have been desperately trying to find people. Right? As Brits, we saw that as soon as all the tech layoffs started to happen, right? There's Land Rover, Range Rover going. If you've lost a job in the tech space, we've got one for you. Maybe they can fix their bloody awful navigation system. Great car, but shitty electronics, right?
And so with this, when let's say we shift into a recessionary environment.
Yep.
I mean, we've been talking about a banking crisis, but really, I look at that and think it was actually a crisis of asset impairment which led to issues for banking. In the same way we saw asset impairment with the UK pension system. It feels like private equity, venture capital, and commercial real estate and residential real estate is all an area where we've got asset impairment that's currently hidden because of mark to markets have not come through, and these are the areas where we'll eventually see this slowing down in the property sector is so huge in the US that if it just slows, that's where you get massive layoffs. Do you see that there's this big problem that actually the banking crisis is not really the banking crisis that we're looking for? These are not the droids you're looking for. What we're actually seeing there is an indication of something that's going to happen in big areas, in particularly long duration assets which have been hit and are impaired, but we just don't know because we haven't seen them fall over yet because they're not telling us.
Yeah, I think that's when you see people like BlackRock walk away from deals, right? It's bad, right? When you see, attempts for people to pull out money from commercial real estate pools, right, and they can get 666 amount of dollars, right? I think it was BlackRock who did that the other day. It's bad, and I think to your point, there is a very large hidden non-public banking funding pool, which is beginning to shrink, and where the metrics are beginning to tighten quite dramatically. Look, I think if you're, some of the good guys will have got, cash. They can call on cash, and this is another thing that people don't realize, right? You get into these private equity deals, and it's the gift that keeps taking if it goes wrong, right? Because they keep calling you and saying, "Oh, we need another drawdown on that program that you signed up for." And you're like, "What?" Right? And they can just keep pulling cash on you for a while. But the problem is who owns these things, right? They're owned by private endowments, right? I think if you're looking to get your kids into scholarship in college, try and do it this year. Not, in a couple of years' time, it might be a little tighter because those endowments might not feel quite so wealthy. This is all contracting behind the scenes, Roger, and it's very difficult to get metrics on. It's very difficult to get a sense on, but we know it's coming. And so, the analogy that I've used is and I know as a Brit you'll be a Bond fan, right? So do you remember GoldenEye? We had Alan Cummings was playing this character, Boris, the Russian programmer, who used to kind of do this the whole time, right, with his pen and bloody annoying little shit. So, end of the Bond movie, you get this big explosion as per usual. Everything's blown apart, and Boris is kind of sitting at the center of this, and he looks down and he realizes he's alive, right? And he stands up and he screams, "I am invincible." And then all of a sudden, behind him, the liquid nitrogen tanks rupture and the poor guy is turned into a frozen lolly or a popsicle, right? And I think that is unfortunately what is happening. I think we are going to see this sort of talk of soft landing, no landing, is really just a problem of delay and obfuscation, because we can't see what's going on in large swathes of this economy. We occasionally you walk around a corner and you go, "Oh, Jesus, that doesn't smell very good," right? But you can't look into the room and see how bad it is because it's all off balance sheet and it's all hidden and it's not public. But if you look at what is going on and you look at, this regional banking crisis, and I think, in fairness to the Fed, they probably averted the heart attack, but have they cured the underlying disease? And I think the answer is no, right? We know that a lot of these regional banks have very large exposures to C&I loans, to, in other words, commercial and industrial loans, to real estate, to construction lending, and it's a very large proportion of their capital, understandably, right? Because that's kind of what the space that you do. But we also know that we haven't really seen any losses or impairments yet. And yet when you look at the credit indicators, they would tell you it's just a function of time. That's coming. And now all of a sudden, if we've linked this, we've created this connection between falling equity prices and deposit flight, which we did with SVB and Sovereign Bank, right? If you've done that, and that is the model that we follow all the way along, who's to say, Roger, in 6 months' time, if we don't get a big super regional bank have to come out and declare big losses on commercial real estate, and then the stocks start to run, and then the Fed's having to come in again and backstop this with liquidity, right? And this is why I get worried about this. Not the commitment of the Fed to try and address inflation, but the ability of the Fed to balance this financial stability versus inflation, or this R double star against this R star. So, yeah, I think the credit crunch, as I said, we don't have many post-SVB credit metrics out yet, but the ones that I am looking at don't look good, mate.
So basically, they're saying that they're tightening credit. They're not going to give it out. They're just not going to. There's just not going to be any liquidity coming from the regional banks because they can't. And this is kind of, it felt like it was going to be an instant death for a few days. I mean,
right.
With all this,
it could have been. It could have been.
Yeah.
We could have gone dug, 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 dug.
Yeah, I mean, it's just the world of social media. I mean, I remember it was the Wednesday before it happened. There was not a problem. On the Friday there was a problem, and on the Sunday there was a bailout. It took 6 months in 2008. I mean, God, I don't have time to think, But it feels like that even with these backstops, this is still, for a lot of banks, death by 1,000 cuts, because the model's broken and there's either they've got a loss on their long duration assets, which they'll never make back from earnings, or they'll see this drip of deposits going. So it's kind of a death by 1,000 cuts for probably.
Yes, that's exactly. Exactly. I mean, it's the difference between a heart attack and cancer, right?
Yeah.
One just takes longer than the other, unfortunately.
So, kind of thinking about this now, I mean, if you've got the gold, you're thinking about the 5-year, 7-year yield should fall relative to the 30-year. You like the precious metals rather than industrial precious metals.
Yep.
We've got a recession. I mean, should people just be holding a higher level of cash at the moment in safe banks if they know what a safe bank is?
Yeah, I think, look, as I said, there's many of the trades that we've discussed and many of the things that right here, right now are quite complicated for an individual investor to do. right? The nice, nasty correction in the relative trade, the steepness of the curve, all those sorts of things, which the pros can kind of take advantage of. It's quite difficult for retail to do. I think in this situation, holding some sort of cash balance is actually, a very, very attractive option. Yeah, I really do.
And then just to
because
finish
you really
it off,
want to try and buy off the lows, and that's what we try and do in Macro Insiders. It's like now buy it, right?
brilliant. And just to finish it off, just changing one more direction, because I know this is one of the areas where you have some of the biggest battles, but on inflation.
Yes.
One thing that I find fascinating about the inflation debate, because I think, we've been talking about recession, which is something which might be here and now in the next few months. So this is a trading thing. But then we've got to set our framework for the next 5 years. What I found fascinating listening to the arguments is that, as you often say, we're both right. It's a matter of timing when you have arguments. But it feels like there's actually a very plausible structural disinflation or deflationary story because of demographics and technology. And I've listened to yourself and I've listened to Luke Groman and others who are actually saying because of that, it's the policy response we have to have that is the reason we're going to get inflation. So in fact, what we have is a structural disinflationary environment that almost lends itself to a policy response that will always and everywhere have those inflationary spikes. Do you think that's fair as what we might actually be going into? So actually, the disinflationary environment is going to be the cause of the inflationary spikes. Yeah,
I mean, look, yes, I think that's sort of true. I mean, I think it goes along a little beyond in the immediate policy response. Because, look, something that Raoul and I completely agree on is you study the macro to figure out when the policy response is to then trade the market, right? So what drives markets is policy response these days, not necessarily the macro, but the macro drives the policy response, so you have to follow that. So look, we've been in a structurally disinflationary environment since common agricultural land was enclosed into fields in the UK hundreds and hundreds of years ago. If you go back, the Bank of England's done some work, and they look at disinflationary trends since the 1400s, right? So, the progress of productivity, Roger, is broadly speaking disinflationary. There is no question that AI is going to be part of that, right? We could be looking at something, what worries me is, you had the sort of Luddite rebellion in British history in the Industrial Revolution where they were rising up against, the spinning jenny and all this sort of thing, coming into a very specific, narrow section of the economy and displacing jobs. And now AI is going to do that over a very broad swathe. So it is structurally highly disinflationary. The question is though, you have these periods throughout history where you get these sort of, on average, 7 years, but can extend longer, of sort of counter-trend rallies in inflation. And to some degree, they're kind of cathartic because you need them to reset the value of debt in real terms. But they kind of happen. And so when I look at this world, I think we're potentially in one of those. I think we're potentially in one of those 1960s, 70s kind of period, a more extended one. A lot will depend on what happens to the dollar, okay? And that's just sort of my sense. And that dollar will depend on how to go back to that thought, how policymakers will respond, right? So, like I said earlier, let's imagine it's end of 23, we're running into election in 24, the election's a year away, and we're in a deep recession. What do policymakers do in the US? Do the Republicans sit back and go, there you go, Joe, right, wear that one into the election? Or do they feel pressure from their constituency to start spending money to help out industry or private equity or whatever it is, okay, which has got itself into trouble? And in that situation, do you give another fiscal stimulus, right, at a time when the Fed will have addressed some of the inflation, Roger, but if you go back and look at history, inflation generally just doesn't melt away, right? It's actually quite that insidious little thing that kind of retreats into the cupboard, and then as soon as you give it an opportunity again, it comes bursting out. And we get, we've had I think wave 1 of the inflation wave was the Trump wave. I think this is wave 2. Do we get wave 3, particularly if the dollar's falling? So, and it doesn't mean that it goes on forever. It'll crest when we get our Volcker, right? When we get our Volcker and someone comes in and really is prepared to put the screws to it. But typically that happens when society is so sick and tired of inflation that they are prepared to put up with the pain. I just don't think we're there yet.
And so we're presumably going from we got used to a cap being 2 to 3% to the floor probably being 3-4%, something like that.
Yeah, I would think so. And then maybe in the next round, it's 4-5, right? I mean, that was the pattern of the 1960s. It's like, I just worry that we're a very soft society now, right? We are not prepared to take any pain. And if you're not prepared to take any pain, then wringing this inflation out of the system is going to be bloody hard, because the politicians are always going to be pandering to get re-elected, and that means spending money or pressurizing the Fed not to be too aggressive. And ultimately, I think the Fed is genuine in its desire. I think Jay Powell is genuine in his desire when he says it's the best thing if we kind of take the pain now, if we wring this out of the system, it gives us the flexibility. But he may not be able to politically deliver that.
So do you think that if that's the case, then he has to try and get that done now, this year, so that next year he can take his foot off the pedal?
I mean, I've heard that explicitly. I mean, from my policy friends who are still sort of, in that policy space, that explicitly one of the reasons that they went aggressively early was because they knew the pressure was going to be material. In fact, my colleague Harry Melandri on Real Vision did that interview with Tom Hernig, the ex-Fed governor, and he said, look, my concern is, what happens when unemployment is 6, right? And they're still trying to figure out whether to cut rates or, how much to cut rates, but they're still looking at that kind of, inflation genie still in the bottle, right? This is where things become much, much more difficult. So far better to try and go aggressive hard, which is what they've done, while the economy looks, and the politicians can't get on their case then, right? Because the economy still has got momentum, but I am invincible, right? Doesn't happen.
But it sounds like, everybody we should all be kind of glued to our screens now, because we're coming into that. It feels like we're coming into the business end of this cycle then, in terms of we're getting the ISMs moving, the unemployment moving. Things are probably going to happen this year rather than get pushed on into next year. Great. Well,
I think so. I think if you put a gun to my head, I would say we're either in the recession this quarter or it's next quarter. I don't think that's a big revelation to the bond market. What may be the revelation is, and as I said, I think is quite how bad it gets. And that's why I'm looking at this credit stuff, and it's beginning to worry me. And then what happens to the dollar in that situation? Because that will then determine whether we can nicely transition, Roger, into we get a nasty downturn, it looks a bit ugly, but then the dollar starts to fall, and that's broadly reflationary. Or, God forbid, not my base case, but God forbid the dollar rallies again into the recession in that risk-off move, because then that's what we refer to as the napalm run, right? Your denominator of risk assets is rising in value, and it's undermining the value of those assets as they're falling anyway. So it's like that, So we'll see. Not my base case,
yes.
but
not your base case, but yeah. So. Well, it's all good. Well, maybe it's not all good, but thank you for that great rundown. An exciting couple of quarters ahead of us by the sounds of it. I always say I hope not the tin hat type, but you never know. Get out the gold.
No, I think just great trading environment.
Oh,
it's a really good...
Opportunities. I always say
it's great to be back, mate. It's great to be back before I'm too old to do this again. Next time we get this sort of macro environment, I may be sitting and dribbling on my shoulder, right? But right here, right now, I still feel sprightly enough that I can take advantage of it.
And the great thing is, everyone, again, as we talked about earlier, people think of recessions as being binary, but there's loads and loads of opportunities during most recessions if people just find the right direction. Great. Well, thank you very, very much for your time. Yeah. It's been great to hear you and your views. And
pleasure, Roger.
I'll be watching them with intent. Lovely. Catch you later.
Thanks, mate. Cheers.